Yeah, I would say in terms of, first of all, the economy, we have now seen a significant softening of the data after what was a very strong first quarter. We saw a contraction in GDP in April. There are probably some payback effects, but nonetheless, we do think we're losing momentum there. And I would also highlight on Tuesday the labor market report, which was on the softer side. We saw an increase in the unemployment rate, some softening in employment growth, and I think also quite importantly, a big drop in wage growth, which of course had been very elevated for a long time. We're now focused on the CPI print, which will come out next Wednesday. Of course, the inflation levels are still high as well, but we do think that there's scope for progress there as well because of a seasonal pattern around Easter transport prices, as well as some correction, of course, of the vehicle tax from the April print. And so bottom line is we do think the UK economy is losing some momentum. We're making progress with inflation, and we do think it ultimately points towards more rate cuts by the Bank of England.
Let me ask you also as well about the budget. Do you think that whole thing is robust enough to avoid tax hikes?
I think, for now, the spending review was really around the allocation of existing spending. There was focus on health, on transport, while the defense commitments were left unchanged. But there was also an emphasis on sticking to the fiscal rules. And I think this is quite important because come the autumn, we think there's going to be more pressure on defense spending and a weaker economy than what is assumed by the OBR. And so we do think there are going to be some difficult choices in the October budget. We're skeptical that the UK can really cut back on spending given defense pressures. And so there probably is a risk that taxes will have to rise somewhat come the October budget.
So what are you expecting for the BOE for the remainder of the year?
Yeah, so next week I think will be quite straightforward. They will hold next week. We don't think there's going to be much of a change there. The messaging towards a gradual and careful pace has been quite strong, which means quarterly cuts. But we do then think that the data will soften enough for the Bank of England to cut in August and then to speed up the pace of cuts in the second half of the year. So we do actually have a speed up in the pace of cuts, and we have them cutting down to 3% early next year, which of course is quite significantly below market pricing. It does go against the current signaling from the bank, but as I said earlier, we do not think when we look at growth, when we look at the labour market, wages and the inflation picture, that we are seeing the signs that the Bank of England wants to see to be able to cut more.
Let us pivot to Europe, I should say, in the euro area and the ECB. The ECB is in a different place. They more or less have signaled that this is it, at least sort of for now. What do you think does that all mean for the attractiveness of the euro as well?
Yeah, first of all, I would fully agree with what the ECB has signaled. We're in a good place. President Lagarde said that many times. The subsequent speakers reiterated that. So I do think it means July is a pause unless there's a big surprise somewhere. We do think that they will cut one more time after that. There have been signals in the direction that cutting cycle is nearly done, so leaving some room, I think, for another cut. We also have somewhat slower growth forecasts, that we have quite a lot of payback in the second quarter from the strength that we saw earlier in the year. And we would also worry a little bit more around the risks on the tariff side. We also assume that the reciprocal tariff stays at 10%, but we, in addition to that, have tariffs on US critical imports, including pharma, which the ECB staff do not have in the forecast. And so we do think that the ECB is going to be a little surprised to the downside between now and the updated projections in September. And so we have one more cut from the ECB at the September meeting.